Coming to you live from downtown Detroit, this is Benzinga's PreMarket Prep with your host, Joel Elconin.
This is a volatile puppy here, isn't it?
And Dennis Dick.
I'm bidding a penny. I will buy the stock for a penny.
With everything you need to start your trading day. Good morning, traders and investors, and welcome to this Friday edition of Benzinga's PreMarket Prep, brought to you by Thinkorswim. I'm Spencer Israel here with Joel Elconin and Dennis Dick. Let us know if you're having any issues in our chat, but we are sounding good on our end. Got a good show for you folks today. Couple of guests for you. First guest will be at 8:15. He is Julian Marque. He is the CEO and the portfolio manager of Marque Investments. He runs his own hedge fund at the ripe old age of 20 years old. So he's first, and then after him at 8:35, after the jobs number, we are talking with Peter Cher, the managing director and head of macro strategy at Breen Capital. Joel, how are we doing in the S&Ps this morning?
Quiet overnight session. S&P's down 2.25. A lot of resistance up there at 2267 and change. A lot of highs up in that area. Also the all-time high close. Crude trading up 39 cents at 54.15. Ahead of the number. Gold and silver are slightly in the red. Good morning, Dennis. Are you ready for this Jobs Friday?
Always ready for the jobs number, but will it be fireworks or will it be a whimper?
We've had a lot of whimpers coming out of the numbers here. The only thing that I just want to briefly mention here is, everyone's talking about 20,000, Dow 20K. We got all these highs up here. Doesn't it feel like that, like it's just too close to it? There's all that paper up there, all the sells, all the buy stops. I mean, just this coming this far, getting this close, it just feels like they just got to clear out the deck, get that paper there, and decide if we're going to continue higher over 2,300 or, have a little bit of a correction. But just a lot of paper up there. I think the market's going to go up there and get it.
Usually that's what happens. You take out a big level. When you get close to level, usually you take it out. You hit some stops, maybe people who were shorting off the level, hit those, and then, and maybe catch some people trying to buy the breakout, and then it usually turns. That's usually how this market works when you get to big hole numbers like that. But I don't know. Like the pro traders don't even look at the Dow. Like I don't even have a quote of the Dow on my screen, so I have no idea where the Dow even is. Can you tell me where it closed?
Yes, 19,899.29.
100 points off. So you can tell how much I care about the Dow. Of, the 200 tickers I'm looking at, the INDU or the Dow Jones Industrial Average is not even one of them. So S&P futures all over my screen. So that's what we look at. As usually the prop traders are always looking at that. But, a lot of people like to talk the number because it's big. But, we've always complained about the Dow Jones Industrial Average because it's price weighted, for one thing. So a stock like Goldman Sachs moving up 3% is going to be worth a lot more than one of the smaller stocks like a Bank America. And then second thing is it's only 30 stocks in there. So you just don't have that, like the S&P 500 is a lot more broad index. So that's our complaint about the Dow Jones Industrial Average. We haven't done it for about 6 months, so we were due. But let's jump over into what is moving here today. And the two stocks that are moving the most in opposite directions are Amgen and Regeneron. Amgen's quietly starting to get back some of its gains. Regeneron, which is REGN, is trading down 20 points here, though. And there was a ruling here from the courts on their drug with Sanofi. Spencer, what's the details?
First reported yesterday, I think confirmed officially in a press release this morning. A court granted permanent injunction for the infringement of Amgen's Repatha patents. And then, Dennis, you were clarifying it for me on the pre-market show. The reason for the move in Regeneron regarding the news with Amgen is that Regeneron owns a stake.
And there you go. And you can see Sanofi is trading down the pre-market, which is an obvious one because directly against them. But Regeneron owns a big piece of that drug. And REGN is trading down 21 points here in the pre-market. Joel, give me some levels on REGN because this one has come off the lows as well.
It has 349.98. Hit that real quickly and now has been on the rebound here. 360 here seems to be the number. You do have a little bit of a seller there, so I'll call that only minor resistance here on the rebound. Coming back on the downside, boy, you talk about your pre-market lows and your daily lows coinciding. That pre-market low of 49.98, boom, very close to that low that you had on the 7th at 48.82, so that's on a comeback trail. Amgen spiked up to 164, not holding those gains, and now just hanging out here at 159, 158 and a half, 159. So see if that can get off the mat here. Gappy area here. I just have a feeling this goes in the rally mode. Might not see that 164. And then Sanofi, that was the other one on the downside here. Let's take a look at that. I pull up Sony Corp.
SNY.
Yes. Boom, boom. That hit 39.60, and now that's on the comeback trail as well.
One thing to consider is going to be an appeal here. So as of now, I guess they can't sell that drug in the U.S., but you'd expect the appeal to come, and I think they left it open for 30 days for the appeal, and obviously you're going to appeal it if you're Regeneron or Sanofi. So this saga is still far from over there, but market pricing in, like maybe a lot of it, is over with Regeneron getting hit to the tune of 5.5% this morning, and Amgen obviously trading up. There was other news here too, though, overnight. We had, going back to the retail sector, which has had news all over the place the last couple of days. We did get a couple big retailers reporting their sales for December. Both the Gap and J.C. Penney reporting here, going in opposite direction. GPS up 9%, J.C. Penney trading down 4%. Spencer, what are the details from these two retailers?
The Gap announced December sales were up 3% year over year. J.C. Penney said November and December same-store sales were down 0.8% year over year. So.
Let's get some levels here, Joel. They're talking about the audio. We're going to fix the audio issues here. Spencer's working on that to get our audio equalized. But let's talk the JCPenney first, because JCPenney's down 3.5%. Got hit hard on the Kohl's Macy's numbers there yesterday. Obviously, the hits continue there with their own disappointing numbers here today.
And this thing had been going into reverse long ahead of this disastrous news. I'll give you the pre-market low at 730. Got a little bit of a bounce up. So just after the decline that this one has, I don't know. I like that 730 more as a support level here. You can see this thing had come off hard up. Seems like every time this thing gets into double digits, it can never hold. I might be holding out for that $7 level. That was support back in February and also back in May. So pre-market low is important in that one, 730. Bad news is out. And then Gap, I saw that gapped up to 26.50 into pre-market trading, back off now at the 25.5 level. A lot of highs up there between 26.70, 26.5 and 26.75. So I like that. I like that as a target on the upside. But as you can see right now, just hanging out at 25.30.
Yeah, anybody who got hit yesterday is probably ringing the register here today, especially if they were buying it on the dip yesterday as well, the Gap. So GPS, I think you're going to see some profit taking as well. And there's just a lot of overhead supply. I mean, up at that 26 level where it was trading in the pre-market, that just shows how crazy this, or after hours, that shows how crazy after hours can get. I mean, you had the big head and shoulders back from October, November, December, neckline all over the place at 26. So you figured that was probably going to be resistance. People buying it at 26.5 got way too excited. Now it's coming back down to earth. It's to 25.30, but it has held on here for the majority of the after hours in the pre-market session. So it's kind of finding its home here up around $25, and not surprising because we had the disaster numbers from Macy's and Kohl's. So when you come out and your sales actually increase, or you're looking pretty good in December, not surprising that they would buy the stock pretty heavy, especially after hitting it yesterday. Let's look here at a couple other stocks that are moving here this morning. And Teva, T-E-V-A, looks like they are cutting their outlook here. T-E-V-A got hit pretty hard on this initial news. It is bouncing back here as well. First of all, Spencer, give us the news on what T-E-V-A said, and then we'll jump into the technicals.
So they see their fiscal year 17 EPS guidance. This is $4.90 to $5.30. The estimate was at $5.13.
That still makes a lot of money. Is that so? How much money are they looking to make? Say it again.
It's EPS of $4.90 to $5.30.
They're talking
Fiscal year.
about, so if they still make, say, $4.90, stocks trading at $37, got a dividend yield of 3.11%. I mean, you're talking about a multiple of 8. If I'm doing the math right, 8 or 9, pretty cheap stock still. So here they are. They hit it down to $36 in the pre-market, and then the value investors come in and say, I've been waiting for a pullback in Teva, and I'm here. Pharmaceuticals have turned here in 2017, so don't be surprised when you see bad pharmaceutical news if buyers do emerge, because there's the people here who, first of all, have been bearish the sector, now looking for pullbacks to buy, because it's been a pretty good first 3 days for the pharma industry in 2017.
Yeah, that decline was quickly scooped up. Pre-market low 35.82. Now back in the $37 handle. Go look at your dailies here, and you'll see there was a lot of daily lows right in this $36 area. So definitely now we're a buck 40 away from that. If we get back anywhere near that $36 area, I think buyers really.
I don't think you're going to get another shot. I think this could close positive today.
I think that's a good call on that one. Then I'll give you resistance, and the resistance yesterday's high, 2 highs in the 38 handle. So in order to get positive, you got to get up to 37.96. Pair of highs at the 38.25 level.
Jumping over here to a few other stocks in the news yesterday.
Actually, Dennis, let's put those stocks on hold for now.
8:15.
Let's go grab our
Time
first
flies.
guest. Time flies when you're having fun, is what my dad always says. Let's go grab Julian Marque, the CEO and portfolio manager of Marque Investments. So we'll be right back with Julian.
Whether you're a short-term swing trader or a long-term investor, you need to check out Thinkorswim, brought to you by TD Ameritrade. There's a reason why Thinkorswim has been named the #1 trading platform, because it has it all. With Thinkorswim, you can trade stocks, options, futures, forex, and virtually every other type of order. Get notifications on mobile devices and interact with other traders in chat rooms. You can also use technical indicators and see the latest investing and trading education in Think Money magazine. If you want to keep up with the markets, you need Thinkorswim. To experience everything Thinkorswim has to offer, open a TD Ameritrade account today. Thinkorswim, the online trading platform for traders and investors. TD Ameritrade, member SIP.
Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by Thinkorswim. I'm Spencer Israel here with Joel Elconin and Dennis Dick. We're on the line with Julian Marque. He is the CEO and portfolio manager at Marque Investments. He is 20 years old and running his own hedge fund. So, Julian, real quick, tell us about your background. How did you get started trading?
First of all, thanks for having me on the show, guys. It's a pleasure to be here. Sure, I got my start trading when I was 11, really. My interest in finance and entrepreneurship started back when I was 8. I understood what my parents taught me, wealth equals freedom in our society, and, freedom to do what you want, help people, obviously help yourself. So that was something I grasped from an early age, and I was always trying to take advantage of that by starting businesses, classic lemonade stand type stuff, kid stuff. And when I made some money, I had some money left over on the side. I didn't want any more toys, so I asked Google, what do I do with it? And then investing came up, and I started learning about that. And then when I was 11, I watched the movie Trading Places with Dan Aykroyd and Eddie Murphy. And after seeing that scene at the end when they're trading orange juice futures, I was hooked. I wanted to know what those guys were doing, and I wanted to do it too. And since then, it's been an obsession.
So tell us about your current trading strategy. Obviously, it's evolved over the years, but
yeah.
How do you trade right now?
So I'm a quantitative multi-strategy manager. So basically, I'm trying to combine a lot of different models, a lot of unique models that are in some way fundamentally uncorrelated with each other but have positive expectancy. And the idea is that the sum of all of its parts is greater No, sorry, like the sum is greater than the sum of its parts. You know what I mean? When you have all these uncorrelated strategies together, when one's drawing down, maybe the other ones aren't. And you can achieve that through having strategies, that trade different products, that are trading on different time frames. And the beauty of automation is that's the only way a human can really do that, right? To manage 10, 20, 30 strategies at once, you need to have it automated in some way. A human's just not going to be able to do it. And just thinking logically, as a money manager myself, if, managing my own money, I want to be making money every year. And the most consistent way to do that is through multi-strategy in some way. The renaissances of the world, that's what they're doing. In order to generate those higher returns, they have thousands of models going all at once that are a little bit different from each other, but they're trying to capture everything. And I think it's better to find robust, simplistic strategies that, have 0.5, 0.7 sharps on their own, but you can be confident that they are taking advantage of a specific edge because they're simplistic and robust in nature, and you let the validity of multiple systems sort of take out and diversify your risk.
How do you find these strategies there? What is your system approach to developing? Because you said you have around 25 to 30 strategies. That's a ton of strategies. How have you found those strategies?
It's a lot of searching. Most of my job is going online, going on blogs, and just looking for ideas, looking through ideas in academic papers. There are some very simplistic strategies. I have basic seasonality strategies, like I'm sure you guys know of the time of month, right? The first few trading days of the month tend to be very bullish in the stock market, and even in the bond market, the last few trading days of the month, most of the gains, if not all of the gains in the 10-year over the last 30 years have been in the last 5 trading days of the month. So, that's just an example of a very simplistic strategy, but then we also have stuff that are looking at, let's say, VIX future rolls, where I try and take out maybe I'll short the VIX and the S&P at the same time in a magic weighting, specific weighting, where I take out the market risk and I just take advantage of the roll, whether it's in contango or backwardation. So really trying to look at everything. And yeah, most of my ideas are just sourced from, blogs going on like quantocracy.com, searching through there, looking at academic papers, and just, looking at the markets in general on a day-to-day basis.
What's your time horizon on a lot of these trades and strategies that you're talking about? Are these like short-term, couple-day trades? Are these longer-term swing trades, like, a month or two? What's your time frames?
My sweet spot is a few days, so, just maybe 3 to 5 days. That way there's some liquidity for down the road, hopefully, when I grow. But I again, by nature of what I'm doing, I have strategies that rebalance monthly, and I have strategies that will be in for 8 hours in an entire month, right? So I have some intraday stuff, and I have some very long-term stuff. But most of my alpha at this point, most of the strategies are focused within the 3 to 5 day time frame.
So Julian, what do you trade? Anything and everything?
At this point, I'm only trading equities and ETFs. If I had my way and if it were easy, I'd be trading futures, FX, options, everything. But at this point, my main investor is restricted to only trading equities. So the majority of what I'm doing is through ETFs, mainly the S&P, so SPY, VXX. But we'll also trade some S&P 100 stocks, and we'll trade commodities, gold, USO, just through the ETFs at this point.
We're on the line with Julian Marque. He's a CEO and portfolio manager of Marquez Investments, 20 years old. Question out of the chat here: do you have in-house quants, or do you work with different partners?
So at this point, it is a one-man shop. I'm the sole managing member of Marquez Investments, and most of the work that I've actually done, I have had to hire, to implement my strategies into live trading. So all of the stuff I've done, all the back testing has been in Excel and Python. But, obviously testing a strategy is a lot different than actually trading it. And so, I've sought some help when implementing, just to make sure, because when you're using different APIs for different brokers, depending on where your investors are coming in, you just want to make sure that you have an expert with that specific API helping you out. Up until this point, all the IP is mine. Only I know it.
Okay.
So you've programmed this all yourself as well? Like you're a programmer too?
Well, again, like basically what I have is a trading bridge that takes a look at like historical data and live data, goes into an Excel worksheet, and then I'll make some calculations basically. Okay. And then I've had someone help me program. Basically, when the orders go to a certain page in Excel, it will take those orders and send them out at a specific time.
And are you looking for trades on the long side and short side as well?
Correct, yeah. I mean, most of the time I'm short. And that doesn't necessarily mean I'm short the market, because I could be short the VIX heavily. But yeah, a lot of the time I'm shorting. When I'm trading the individual equities, most of the time it is to the long side. There just seems to be better edges that way. But, I would say about 10-20% of the time, just in the individual stocks, we're getting short. But since we're managing so many different strategies, we're generally uncorrelated with the market. There will be times where we're long with the market, but it's rare.
Hey Julian, this is Spencer again. Can you share with us any specific stocks on your radar right now?
Well, to be completely honest, I don't really look at the individual stocks in that way, right? It's more so just taking a look at it as it's in an index, because I only have one portion of my book, one strategy dedicated to trading individual stocks. So really, there's not much insight I could give from that, because most of the positions are in and out between 2 or 3 days, right?
So then what indexes are you looking at right now?
The S&P 100. So one of my strategies is a long-short directional system. It's basically looking to buy pullbacks in stocks, both on the upside and downside. And it takes advantage of a market on close indicator that I've developed. Basically looks at capitulation in the last 15-30 minutes of the trading day. You'll tend to see that a lot of capitulation to the downside or to the upside in the last 30 minutes of the trading day tends to be mean reverted in the overnight session. And the more liquid the stocks are that are capitulating, the more likely it is to mean revert, I found. So trading the S&P 100, basically the most liquid 100 stocks in the United States, is the best real subset for me to look at, and it's the most liquid, so it's easier to trade.
One more question from our chat before I let you go. Do you look at the SDS and the SSO at all?
No. Usually if I'm going to be shorting, I'll just do it outright. I'll just do it through the S&P.
Awesome. Well, we've been on the line with Julian Marque Investments, and you're a student at NYU, is that correct?
I was. I dropped out a year and a half ago, so
right.
I'm doing this full time.
Dropping out to trade. That's the way they do it. All right, Julian, thank you so much for joining us today. We will definitely talk to you again later in the year.
For sure. A pleasure. Thanks, guys.
All right,
appreciate it. Bye-bye.
So, were you guys trading at 11 years old?
No. And I don't know if dropping out to trade is the way to do it either. I think it's a tough career. I think finish your schooling, and obviously then you can look into different stuff. But but this Julian, obviously he's found a niche here, and good for him. That's fantastic. I think it's very difficult for a 20-year-old to come into the markets and be successful right away like he has. So great job for Julian there. But I don't know if I'd follow that lead by dropping out to trade, because I think a lot of people are going to struggle with trading for a long time. So I like having that backup of having your education.
He sounded wise beyond his years for
really
20. Yeah, today very.
sophisticated prop trading tools using too. Like, when he's talking about, looking at the closes and capitulation and stuff. Very, very impressive for somebody who's 20 years old. I mean, I didn't have any of that knowledge at 20 years old. I didn't start till I was 22. So, wow, that's impressive.
All right, 2 minutes here before the big jobs number. S&P's hanging out here at 2262.50. Dennis, you want to sneak another issue here? You want to get ready to trade?
I want to go. I'm going to go get ready to trade the number myself, so I'll let you guys sneak an issue.
Sure.
But lots of ratings changes. AT&T and Verizon are ex-dividend here today too, which is always interesting. So I'll leave this with you. I'll be back at you in a few minutes. I'm going to go trade this jobs number.
All right, looking ahead to that in just about a minute from now. What did we get last month? For November, we had 178,000 versus 175,000 in non-farm payroll. So the expectation for this month will be, let me pull it up on my screen real fast, is 178,000 and 4.7% unemployment rate. That's what we're looking at. We're looking at 178,000 and 4.7% employment rate, so we're looking forward to that. Joel, give us some technicals right now.
All right, the S&Ps, folks, a bunch of highs up here at 2267 and a quarter to 75. You had your December 28th high. You had a high earlier in the week. All-time closing highs 2267.50. All-time high 73.50. Yesterday's low, Thursday's low, down at 54 even. No one jumping the gun yet here on the number. Spencer will bring in the number. I'll give you the movement in the S&P futures. The world awaits the jobs number. I guess if it's good, Trump can take credit for it, and if it's bad, Trump
We got non-farm at 156. Sorry to interrupt you, Joe. 156 is the non-farm.
Oh, boy. This could be an all-time low for movement here.
Private sector is 144, so both of them missed. Again, 178 was the estimate. That was also the prior, so 156 is what we get for December. 144 in private. 170 was the estimate there, so missing on both.
Look at that. We've moved a point so far. A point and a quarter here. No fire. I mean, do people know the numbers out here? It's not moving.
Weren't we just saying this unemployment again is 4.7%? That was in line with the estimate, so not bad there. But weren't we just saying on the pre-market show? It was asking if Dennis was even going to step away to trade because the last few have been snoozers.
Yeah, definitely. Flack UK. Last three have been non-events here. Getting a little bit of a boost. We've gone green on the session. We moved just a couple points here. I am just, I guess I'm not surprised because this is what's happened. So we'll just stick with our numbers. 67, 75 on the upside. That's your major resistance. Coming back on the downside here. Haven't even made a new low at 61.50. Below that, we have Thursday's low at 54 even. I'm also looking at the top 10 components here in the S&P, and they're not even changing. I mean, there's just no bids or offers. Maybe Dennis can come on here in a minute or two and see if there's any action. The financials are not moving.
Well, we had BAC spiking down about 1% on some volume. Bank of America right at the number. U.S. manufacturing payrolls, to go through the whole list. U.S. manufacturing payrolls at 17,000. Versus a zero estimate. The prior was down 4,000 month over month, and government payrolls were 12,000 versus 7,000. Estimate the prior was 22,000. We're in a bit of a weird period, the lame duck period in between administrations. I'm sure that has something to do with it there. But quiet all around here. BAC is the only stock that I really saw spike in either direction. As a result.
Financials are moving. The financials are moving a little bit. They're right, Spencer. They hit them on the initial number. You can see Bank of America got hit. Also, J.P. Morgan got hit all the way down to 85.50. Somebody hit it. Just a couple thousand shares. They're going to regret that because financials have turned up. And we're actually in the XLF. We're trading higher here now. Bank of America is now up about 0.35%. It's up 8 cents here now. So Goldman Sachs, which got hit on the initial number as well, they're going to regret that too because it looks like at least initially they're going to regret it here because it does look like J.P. Morgan just went green here, 86.14. So it looks like they're trying to buy the financials up a little bit, but it's a whimper. I mean, this is another jobs number that really doesn't move the market here either. It seems like nothing moves the market here anymore. I mean, good news, bad news, the market just kind of hangs out. The VIX keeps falling, which I hate. Obviously, as a trader, I love volatility. I love it when the VIX starts going up. I've always said over the years, there's a very positive correlation between my trading profits and where the VIX is at. As the market's more volatile, I make more money just because, my strategy strategies. Obviously, stock moves around 50 cents or stock moves around $1.50. There's a lot more potential to make more money. So as a trader, I hate this. I wish you'd see some chop, see some volatility. But as an investor, I guess this is what the markets they want. They want the slow, steady, boring climb, and that's what we got.
All right, out of the chat here, RMH is asking about IONS at this price. That's a pharma stock. Must have had some,
today.
must have had some good news here. 51.50. We hit that in the pre-market. Now you have some people that got caught in this quick slide here from 57 even down to the lower 40 handle. So I think you're on a pop here. You're going to see some sellers. 51, that's your pre-market high. Your pre-market high is 51.50. Coincides with a high here at 51.65. So that's a big level. If it can clear that, there's air open up to 54.57. But right now, I'd like to see continuation through that pre-market high. S&Ps are perking up a little bit now here, Dennis. Yep, we're in the green here. I guess everything is okay here in jobs land, and I guess raise interest rates, that would be fine too. But as I talked on, before we started the show, there's all that paper up there. There's everyone thinking about 20K, Dow 20K. Dennis, what kind of odds do you give me that they get there today?
No,
100 points.
you think it's going to hit there today?
It could, yeah. I'd take.
It could hit there any day. It's only 100 points.
Yeah.
But why? So you want to make a bet here? You want to make a bet?
I want some odds on this one.
Nah, I don't give you odds.
Okay.
It's only 100 points away, and we're rallying like crazy right now. It could hit it right now.
Oh, that's 100 points. Okay. All right. We are going to take our final break of the day. We got a special guest coming on. That's Peter Cher. He's the managing director and head of macro strategy at Breen Capital. See what he thinks of this job number and the markets for the year. We'll be right back with Peter. Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by Benzinga Pro. I'm your co-host, Joel Elconin, along with Dennis Dick and Spencer Israel behind the glass. We are on the line with Peter Cher. He's managing director and head of macro strategy at Breen Capital. Peter, how you doing on this jobs number Friday?
Good. We've got a little bit of snow out here, and the job numbers was kind of very strange, I guess.
Strange?
Very mixed. I think you could make... Yeah, I think, you look at the headline numbers, jobs are a little bit weaker, so you could make the story that, hey, maybe the economy is not as good as people hoped and that the animal spirits have got ahead of themselves. At the same time, you saw a big increase in, wages, so there's some case to say maybe the economy's turned the corner and you're going to get that wage growth. So it's kind of a very sloppy report to me with a very inconsistent message.
And that's kind of during our conversation yesterday. You're not so convinced that the Fed is on this pace to raise interest rates 2 or 3, 4 times this year. You're more in the one and done camp. Are you more December is the one and now we're done, or you think we may get one more in this year in 2017?
I think they're going to try and get one more in probably, February. They're going to wait a little bit until, Trump takes over. They clearly want to hike a little bit more. I just don't think the data is going to be supportive enough for that.
So it's kind of like a best case scenario. It's like interest rates aren't going up, so equities are still, your best investment in the long run, as long as as long as Fed keeps the course steady. Let's move on here and let's talk about the Trump administration here. A lot of expectations built in here after the election. What he's going to do for infrastructure, what he's going to do for different parts of the economy. On the other hand, he's backed off on some other things. Give us your assessment here of the Trump rally.
Yeah, I'll definitely go through that. One thing I did want to mention, even on the Trump issue today, I think it's very curious. He came out and tweeted against Toyota, knocked Toyota stock down. But it's really the first time, if you look through what's going on Twitter and in traditional media, Toyota's fighting back a little bit, and the Japanese government's pushing back. So he's kind of had, almost carte blanche where he says something, things happen, he gets his way. This could be the first time where people are going to say, hey, we have a business to run. We're running it on a global basis. We're doing the right things for our company. Some of that involves, auto plants in Kentucky, and if we need to build one in Baja, Mexico, we're going to do it. So this could be a very interesting turning point, and I think feeds into the rest of my issue, which is he is not going to have as easy as the time getting things done as he would like or the markets have started to build in.
All right. And, he's backed off on the wall and other things as well. 2017, you think it's going to be the year of the active manager. Explain that to us.
I really think that a couple things are coming together that will give the active managers the opportunity to outperform and to shine, and also they have the need to do it. So I think it starts with the necessity. That the past 2 years you've seen massive flows into passive strategies. I think, active managers, whether it's on more simple long-only equity strategy all the way to, super sophisticated hedge fund strategies, they've been on their heels. They've been losing assets, to lower margin products, to passive investing. So I think there's this need to draw this line in the sand and really aggressively take the risk, trade, and make money this year. And I think you also have the opportunity because the last couple of years have really been very, very heavily driven by central bank policy. I think central bank policy is changing. It's not quite as cut and dry. And at the same time, you really have this political policy driving to the forefront. You've obviously got Trump here. You've got Brexit still playing out in Europe. You've got a vote in Italy that was against the status quo. You've got Merkel losing support. You're not quite sure what's going on in China. You're getting very mixed signals out of there. So I think there's actually a lot of opportunity to pick and choose winners and losers. And right now, one of my things would be, listen, if you're actively managing, I think you now want to be getting out of some of the things that have rallied on the back of Trump, and you want to be getting in on some assets that maybe underperformed. I look at MLPs. MLPs, I think, are really going to benefit from Trump policies. They've lagged because of tax concerns. If I'm right, the MLP parts will get done. The tax stuff will get pushed off a little bit, so that could rally. And I'm also starting to look at municipal bonds again. Municipal bonds have been very unloved since Trump won. And in particular there, I like some of the closed-end funds where you're seeing discounts to NAV of over 10%. So you're buying something on the cheap that's unloved that would not take much, I think, to turn it around.
All right, taking a look at the Muni Bond ETF, that's hit a low and is definitely on its way back here. Also, you recently wrote about stupid beta and that perception. Could you explain that term to us?
Yeah. Last year, one of the things that really hit me was there was all this money flowing into min-vol and low-vol funds. So they were trying to invest in strategies that should have limited volatility or traditionally had limited volatility, and they were equity-based strategies. So I think a couple things happened. At some point through the whole selling process, someone winds up buying these types of funds almost with the perception that they've got the upside of equities without the downside, and that's just not the case. And what I think investors missed, even the fund managers themselves missed, is some of the characteristics that had made these stocks low volatility were going away because the PE was getting pushed up as you had these inflows. The dividend yield was going down as you had these inflows. And all of a sudden, they were a very large percentage of some ETFs. And so when those ETFs had outflows, you had this big drop. So I think this concept of beta and the passive investing makes some sense, but it tends to be very retroactive. What's worked, what correlations have existed before, and doesn't do enough really quote-unquote smart beta when you want to say, hey, this has happened in the past, but is there any reason for that to continue? Or, in fact, should it reverse? So I think that's where active can come in as being, putting smarter filters on beta rather than just saying, hey, this strategy worked, let's put it into a smart beta ETF. And that's going to continue to offer opportunities for investors who want to bet against flows and trades that seem overdone.
You talk about a reality problem here, the Amazon effect and economic data being horrible. Talk about, you saw the effect here that it had on the Christmas shopping and Macy's and Kohl's here. Talk about the Amazon effect on our economy.
So this is one thing I think is also affecting why this jobs number is weaker this month than last month is all our data tends to rely very heavily on seasonal adjustments, and that's all based on history. And as we see these rapid shifts and change where, 3 years ago Amazon was important in terms of, the Christmas selling season, the holiday selling season, now it's clearly paramount. And I don't think that gets picked up in the data very well. I think things like FedEx drivers have to get hired earlier, which boosted employment back in maybe October and November. Clerks don't have to get hired, so it changes this. I think a lot of it's similar to what we've seen in the cut the cable, where you definitely have the millennials with different spending habits, different TV watching habits, different electronic habits, and I don't think that gets picked up very well in the data. So that's something we as investors and managers have to sit there and say, hey, the data is based on these longer-term trends. I think, personally, some of these trends have shifted very dramatically, and that's why right now I think you're going to see weaker data because a lot of what Amazon does got pulled forward in the data, and now we're going to see that, hey, they overestimated retail spending, retail shopping in a traditional sense, and that's going to have an impact on the market.
Yeah, that fits right into your thesis with the amount of rate hikes we got going this year. Valentina wants to know if there are any, or could you share with us some of the particular MLPs that are on your watch list?
I really don't go into single stocks
Okay.
as a macro strategist. So I would look again. Some of the smaller ones might be interesting. I could see that being an area where you actually get some good M&A activity, where if I'm correct, and why I think MLPs will do well in the infrastructure spending is Trump is going to need some quick wins and some easy wins. And if you look at the Republican Party, there's a lot who have energy-based fortunes or come from energy-heavy states. So they'll support anything that's energy-related. So MLPs are a good way there. You have this other part of the Republican Party, which is clearly very defense-oriented. So anything that could be portrayed as providing energy independence should get the support. So again, that helps the MLP side. As they're worried about just building up the tax base, the nice part about MLPs is there will be a toll that comes back to the government. So there'll be a fairly, routine and projected cash flow that the government can get back. And then the last phase is purely political. Obama has done a lot to, distract or disrupt the pipeline industry. It would be a very, nice slap in the face, to say the least, for Trump and the Republicans to, push that over and demonstrate that. So I think energy transmission in this pipeline area will be one of the easier infrastructure spending elements for them to get done. And within that, then, you're going to see that growth. And I could see some of these smaller companies becoming very nice takeover candidates for some of the larger guys who want to grow quickly.
Just want to talk quickly here about the financials. Nice run on anticipations of higher interest rates, and also, regulation. Are these Trump policies going to go through as easily as people think? And just give us your macro assessment of the bank rally.
I think the big bank rally is overdone. The interest rates aren't going to be as high as people would like. That net interest margin that people are anticipating takes so long to kind of hit the balance sheets and income statements. I think they're going to be disappointed there. It's going to be good that there's reduced regulation. I believe the Volcker rule is not going to be enforced. But the reality is banks really need high turnover, generate returns, and that's whether it's in the trading business or in the mortgage business. And I just don't yet see that level of economic activity to really drive turnover. I think at the smaller and regional bank level, there's some more interesting opportunities. I think maybe some of the BDCs, anything that's going to be a little bit off the radar screen. I do believe the Republicans are listening and saying and responding, saying, "Hey, we need to make it easier for smaller banks, smaller institutions to be competitive. They're not the ones that are going to drive the economy if they get something wrong. They can't afford these expenses, and yet they're the ones who are best positioned to fund small cap growth." So I think there's more opportunity still at the smaller institutions rather than the large institutions. We have to yet see, though, whether he gets this delivered and whether there's the underlying loan demand. Again, a lot has changed with Trump potentially, but for the past 4 years, we really haven't seen strong loan demand. There isn't that animal spirit driving business. So if that doesn't change, it doesn't matter what the net interest margin really is going to be. If banks can't produce new loans to people who really want them, I just don't see the revenue growth there.
All right, before we let you go, your final take on Union on the consensus. Sell the inauguration. Wrap that up for us.
So I believe most people are expecting a small pullback when he gets inaugurated. I'd actually rather be cautious right now. I think this Toyota tweet that we talked about earlier is maybe the first sign that this isn't going to be easy. If we go back, even Obamacare, replace and repeal, or repeal and replace has been the talk, but no one seems to have an accurate plan of what to replace it with. I think the market's really quickly going to realize, hey, this takes longer than we expect. It's not going to be a Q1 event, a Q2 event. It may even be a Q4 event. So I'd be selling out of risk right now. I'd be particularly selling anything that really benefited from the Trump rally, and I'd be adding a little bit of risk to areas that have underperformed and might do well. And I think this is going to be a year where we want to be cautious, you want to be rotating, you want to be constantly looking at your portfolio and making sure you don't get too carried away, long or underweight any particular area.
Peter Cher, Managing Director and Head of Macro Strategy at Breen Capital. Great insight into the markets, Peter. We'll have you on again soon.
Thanks very much for having me.
All right, S&P's hanging up a point here, 2265 and a quarter, just knocking on the door, trying to take out all those highs here at the 2267 area. Dennis, I think that what Peter what he says makes a lot of sense to me as far as the expectations in the market and what actually is going to get done on Capitol Hill.
Well, I mean, this is stuff we've been saying for a while, too. Like, I feel like the bank, I think I'm on the same page as him. I feel like the bank rally is overdone. I don't think we're going to be able to go in there and repeal Dodd-Frank, and it's going to be the Wild West of banking here again. I don't think interest rates are going to fly up like everybody thinks that they might. And, also, looking at Trump, and I just don't think, it's going to be as easy for him, too. I completely agree with everything that Peter said there. So, again, I agree with his conclusions, too, because it's all about rotation. It's about finding those, the rotation. The money flows, and it continues to flow for a while in one sector. It gets loved, and then everybody gets, and then it gets crowded. And once it gets crowded, it breaks. And then, obviously, this starts to turn those sectors, and they start to go down. And then they get hated again. I mean, the retail is a best example. Just look at, a stock like Kohl's, which is a classic example of how we felt about retail through 2016. And in the beginning of 2016, we had a little rally in, January, February, March, and then we got hit. And Kohl's went all the way down, from $50 down to $33. Everybody hated retail down there. Amazon was taking over the world. There was going to be no more big box stores, no more department stores. It was over for them. Everybody on CNBC was coming on bearish. And then what happened? It was crowded the other way. And we had a 6-month rally in Kohl's going from $33 up to almost $60. What happened, just about 2 months ago? Everybody's bullish and saying, department stores, they're figuring out online. They're figuring it all out. They all just chase price on CNBC, and not just CNBC, it's just the media in general. They're all chasing price all the time, and they're always late to the party. And, when everybody gets on one side, it almost always goes the other way because the trade is crowded once again. And what happens now? Pull the rug out from underneath them again, and now they all hate them. So they all hate them at 30 and 40, and they all love them at 60. That's backwards, guys. They got it all backwards there. And if you're playing it that way, you're losing a lot of money. So, I've always been a contrarian investor. Trading's a little different story. You got to ride the waves because they seem to last for months on end. But as an investor, I still feel, there's good value. It's like why I was buying Procter & Gamble when everybody hated it at $68 a year and a half ago. Why I sold it up at $88 when everybody loved it. Same thing with Kohl's. I was buying it at $40. I was a little bit early on the Kohl's because it went down to $33. But, I sold it into that rally because, it's just about fading that contrary, that opinion out there. And, I've made money on my investment portfolio for a long time by fading the herd. And the herd is the best indicator for the herd is everybody on the major media. Twitter is a great indication for herdy too. You look at it. If everybody's bullish a stock, man, that's telling you that it's maybe a crowded trade and maybe ready to go the other way. And that works intraday too. I use that, sentiment in my intraday trading as well. Even, you're looking at a stock that's hot, hot, hot. Now you see everybody tweeting about it, everybody's getting in, everybody's, this is, the next big thing. And then the bubble bursts because it's crowded again. It's just that cycle, that rotation. But if you can identify the sectors, if you can identify the stocks, when the rotation just starts to turn, you can make a lot of money because it seems like the trends persist, sometimes for months on end.
All right, real quickly here, MLPs, Dennis. I don't think I have any of those in my portfolio. Bob Wire says they're risky, though definitely took a haircut when oil took the slide now. But now that it's stabilizing a little bit, taking a look at a stock like Kinder Morgan, I'm sure the yield is way up there on that thing. Is that, when you're looking for yield, is this something that...
Well, Kinder Morgan actually, because they got rid of their partnership. They used to have KMP and KMR, and those were their classic partnerships. And now they've reorged it all. They cut the dividend last year when they were having problems there, so the dividend actually is a little bit less than the KMI. But there is a lot of MLPs there that have 7, 8, 9% yield still. And the way they're structured, sometimes those yields can be supported. A lot of your MLPs are in the oil sector as well. So like you were saying, a lot of those are related. You can still find, there's still REITs and there's other, ways, similar investment vehicles there that you can participate through as well. But, it's always, when you're buying something with 8, 9, 10% yield, you're taking on a little bit of risk, and they cut the dividend, the things get hit. So that's something to consider. But, a lot of these have paid people for a lot of years. So if you've been an MLP investor for the last decade, you've probably got a lot of your money back, if not all of it back, over the course of the last 5 or 10 years, just from the dividends that they're paying.
And talking yield here, FLAC UK, are there any good preference share ETFs that are showing that have some decent yield?
Well, if you want to get away from the MLPs and preferred shares, if you're talking preferreds, it's a completely, different ballpark there. Preferreds, obviously, are looking, it's kind of a hybrid between debt and equity there. And I'm a big preferred investor. I'm not, and Bob Wire doesn't own any MLPs. He's saying, I don't own a lot of MLPs either. I prefer to look at preferred stocks. And I think preferreds are a great way to own the market because, first of all, you have an underlying stock that you can follow, to see, hey, this is doing well. So I'm probably pretty safe in this preferred. I talked about DDT for a long time, the Dillard's preferred. And I've had that in my portfolio. I finally sold it, just last year because and I shouldn't have actually, because it's been paying me for years and years and years. I finally sold it because the retail's starting to roll over, and I was like, I don't know if I want to own Dillard's anymore, with the 7% with the preferred. But DDT is the preferred stock of Dillard's DDS. This is callable. It's been callable forever. I had no idea why Dillard's doesn't call it in when they're paying out 7%. They could probably reissue that at 6 or 5, but if they're sleeping at the wheel, I don't know. But it's been callable for like the last decade, and they haven't called it in. Still yielding 7.26% dividend. I mean, if you think Dillard's is going to survive, that's a good one. But, now I look at it, Dillard's at $56, and some people are saying these department stores are in trouble. So it's not as attractive as it was last year when the stock was at 120. When Dillard's at 120, I'm pretty confident that the preferred, the preferred isn't going to start to get hit. But if you see Dillard's start to go down to 20, 30, $40, they could start hitting the preferred, getting concerned that, hey, maybe there's some other issues here. So I don't know if I like that one as much, but lots of your banks have preferreds. If a lot of people are talking about just buying the banks flat out, but there's lots of bank preferreds out there that have 5-6% preferred dividends as well. So that's another sector you can look at as well.
All right, 8:57 here, 3 minutes before we end the show. S&P's creeping up on the highs of the sessions. Getting some buying balances there, Dennis?
We haven't even looked here yet. Let's go take a look here because I've been busy. You know what? Not really. I'll be honest with you. I think there's a few more selling balances than buying balances, but they're all small. So when you see them this small, it's all going to change in the last minute because there's just too many, big institutions that come in at the last minute to change things up. But Bank of America actually shows a selling balance, 158,000 shares. It's trading up 14 cents. 158,000 is nothing. One institution comes in and says buy 200. That'll change. So I'd imagine that's going to flip to a buy if, the strength in the financials continue continues and persists here through the pre-market, which is what we're seeing. I mean, really, if I'm looking at my sectors here, I'm looking at what's strong, what's weak. What stands out to me so far, since the 8:30 jobs number, is the financials. They are looking a little bit stronger. Goldman's trading up over $1. We've got Citigroup and J.P. Morgan. Now, J.P. Morgan, remember I said 85.50. That guy was going to regret hitting that. It's now 86.65, so they're $1.15 underwater there. So got to watch hitting right on those jobs numbers there, because you're the first guy hitting. Sometimes you're hitting the wrong way, and there's not a lot of liquidity. And somebody had an oopsie, because 85.50 for 2,000 shares, now 86.55. Somebody just threw away $2,000. So, there's money to be made, money to be lost on the jobs numbers just because of the lack of liquidity. But Wells Fargo, 95,000 to sell. Again, I think that will reverse. I think that's probably going to go to a buy and balance. Seeing a little bit of strength in some of your pharmaceutical companies. That has continued to be the theme here for 2017. Drugs and pharma have been strong. I see Merck trading up a little bit in the pre-market, although very light volume. Pfizer's a 47,000 share buy and balance. That's trading up about a dime in the pre-market. Some of your other pharmaceuticals are starting to turn up a little bit. Some of your oil stocks are starting to show a little bit of life. Oil has quietly rallied about 1% here in the pre-market. We look at Exxon and Chevron. Both of them have turned higher here as well. So there is definitely some sectors of strength, sectors of weakness. TLT has rolled over here now. So again, think that dividend type of stuff. That could be weaker here today. If we look at AT&T, which is ex-dividend here today, I actually shorted some AT&T just a little while ago off the jobs number here. I'm probably going to bring it in here sometime today. But one thing I didn't mention here, and I know I've been really going on a long time talking, run-on sentence here, but AT&T and Verizon are both ex-dividend here today. And they have both had incredible runs over the course of the last month and a half. We typically say AT&T is usually stronger and Verizon usually stronger about 2 to 3 weeks ahead of the ex-dividend date, and then weak usually for 2 or 3 weeks afterwards. This is a classic setup here for Verizon and AT&T, and I would not be the least bit surprised if both of these stocks show weakness here over the next couple of weeks. As you know, they're now ex-dividend.
I followed you on into that one yesterday, Dennis. I popped on the close. I got a little bit of that AT&T short as well, but I'm not looking to get out today. All right, S&P's hanging up near the highs, 2266.50. 9 o'clock, Spencer. We started a little late, going a little late. Why don't you wrap things up?
Couple of great guests. Well, actually, all of our guests are great on the show next week. We got Nicola Duke coming on the show. Mark Chaikin, as I mentioned, I forget if it was either at the top or if it was on the pre-market show. He's Chaikin Analytics. This guy came out of retirement to develop his own proprietary trading software. I got a demo of it yesterday. It's really excellent. So Mark will be on Thursday. Wednesday, we've got Jeff Goldman, an old friend of Joel's back from the Merck. Not sure how they ever became friends, though. Jeff is a Michigan State guy. Jeff is the author of Failed Traders, the 20 Common Mistakes Committed by Over 1,000 Losing Traders. So Wednesday, we'll be talking a lot about losing traders. It'll be a good show. It'll be a great show all week. So a full week next week. First time we've had that in a couple weeks now. So looking forward to all those guests and all of our shows next week. If you missed any part of today's show, catch the whole thing again on YouTube right after the show ends, and also iTunes, SoundCloud, and Stitcher. Don't forget that all the information, material, and content from our show is for informational purposes only and not meant to be investing advice. Also, if you want that free 2-week trial of Benzinger Pro, call us up today. You can get it by calling us up at 313-723-2000, or you can just go yourself to pro.benzinga.com. That's it for us for the week. Hope everyone has had a good morning so far. Hope you enjoyed that job number and you have a good rest of your day and a good weekend. We'll be back with everyone nice and fresh on Monday.